Welcome back. Investors all around the world, including in Canada, are watching with some apprehension as this man, Donald Trump, gets ready to take his second oath of office in Washington, D.C. on Monday. Let's go to a senior strategist for his take on the market consequences of a Trump 2.0 administration. Marko Papic is chief strategist at BCA Research, and he joins us now. Marko, thanks a lot for joining us. I've read some of your recent notes, and you've taken note of the fact that U.S. long bond yields, the long end of the U.S. yield curve, has steepened recently, and you refer to Donald Trump as a, quote, human steepener. I haven't heard that phrase before. Tell us what you mean by that.
Well, I mean that the market has basically focused on the one part of President Trump's policies that we have the highest certainty about, which is that he will expand the deficit and continue with his policy of pro-cyclical fiscal stimulus. And therefore, the bond market is reacting to that by basically bidding up expectation of growth, which is why yields are rising. But also, I do think there's a little bit of a fiscal premium, term premium creeping in as well, with the concern that deficits are going to expand. And I think that that rise in bond yields is something investors are watching very carefully and worrying that it could potentially slow down the pace of growth and also have an impact on equities.
And of course, rising bond yields and rising interest rates are typically equity market negative.
Yes, especially when they're already elevated. You know, the first time around, he was also the human steepener, but nobody cared. Back then in 2016 and 17, bond yields were low, and quite frankly, the bond market was begging for anybody to reverse the austerity fetish that had really seeped into both Europe and the US. And it ended up being Donald Trump with his 2017 tax cuts, which were appropriately timed in a way because the bond market was screaming for more spending. This time around, I don't think that's the case. And so I'm really focused on this policy issue because there's a lot of uncertainty about tariffs. We don't have as much clarity on that policy as we do on this fiscal. Now, how sustainable is the bond market reaction? Well, I don't think it's that sustainable because I think there's already chinks in the armor, if you will. There's already clear move back from the Trump administration in terms of how much they want to spend. The House of Representatives, the fiscal conservatives there, they're starting to get some wind in their sails, and they're starting to actually throw sand in the gears for President Trump's fiscal agenda. So I think that the way investors should think about this is that we first get the sell-off, bond yields probably break through 5%, maybe even go as high as 5.5%. We do get some agita in the equity market, but that then forces President Trump and his team to tone down some of their most ambitious plans in terms of how much deficits they increase.
Over what period of time would you expect that scenario to run out? What portion of the Trump administration?
Well, my view was sort of by the second quarter, the bond market move will end, and we will realize as investors that the fiscal gravy train, which has really powered the U.S. economy and its assets for the last 5 years, is coming to an end. But I got to tell you, this week, my confidence in that has been shaken just because the news flow out of Washington, D.C. is pretty much in line with mine. In other words, more and more members of Congress are starting to realize that the bond market has woken up. So it could very well happen within weeks that we start realizing that President Trump's team is really only going to try to push through the renewal of the 2017 tax cuts. Scott Bessent, of course, the Treasury Secretary appointee, had a great hearing yesterday. And I mean, he really only focused on that tax cut extension. He did not mention any other promise that President Trump made during the campaign, whether it was tax cuts and Social Security tips or other such measures.
So you believe that Trump will moderate his fiscal agenda in the face of rising bond yields and a potential cooling effect on equity markets? Do you agree, by the way, that he puts a great deal of importance on the condition of the stock market during his administration, that he views the stock market as a key barometer of the success of his administration? Do you agree with that view?
It depends. I do, but I think we're sometimes overly myopic about that. I mean, President Trump can, chew gum and walk at the same time. And so if stock market goes down 10, 15%, but he knows that ultimately his policies will be positive, I think he can look through volatility. And so what I tell my clients is don't expect him not to rock the boat, either with tariffs, or maybe fight the bond market for the next month or two, say, no, I don't care if yields are going up, we're going to do all these things. I mean, he can be pretty aggressive, knowing that eventually he will compromise. I mean, that is in his head. He has that knowledge, so he can look through that volatility. And so if you're an investor and you just expect the S&P 500 to keep going up because, Trump cares about the stock market, I think that would be a wrong move.
Okay, we're out of time, but I want to squeeze in one more question about his pledge on tariffs. Are you in the camp that this is a bargaining position and that he will moderate his tariff position as well?
I love the way you put that. Which camp are you in, right? Are tariffs an end or are they a tool? So I'm in the camp that they're a tool. The problem is it's a very crowded camp. We don't have any more room where to pitch our tents. There's a lot of us in this camp, and that worries me. It worries me that it is the consensus view. And I do believe that President Trump has an interest in making people like me look extremely stupid over the next 3 to 6 months. Why? Because if tariffs are a tool of negotiations, he first has to convince you that they're an end in of themselves, because that will help in those negotiations. And so just keep that in mind. Don't be overly sanguine. The view is in the price. It is consensus. President Trump will rock the boat in the first 3 to 6 months. That is a risk, obviously, to Canada, but also other countries as well. However, it doesn't mean that he will not modify that stance later after the volatility passes.